All right, so NEOS came out with some new filings for some new ETFs, okay? And these are the NEOS boosted income ETFs that are going to be covering the underlying assets of SPY, QQQ, and BTC. So similar to SPY-I, BTC-I, and QQQI, these are going to be somewhat similar, but have a leverage component to it, synthetic leverage component to it that will boost its income and boost its annual yield. So let's look at these and jump into some examples of what is going on here. All right, guys, so first and foremost, shout out to the Patreon community. I really appreciate every single one of you that is commenting, engaging, and has participated in the Patreon. We're up to 78 members. So please, if you want financial coaching, or you want access to the calculators, or you just want to buy me a coffee, please jump into the Patreon and sign up. I really can't appreciate it enough. I will leave a link in the description to sign up to the Patreon, so thank you for that. All right, guys, so NEOS has filed for some new ETFs. And as I mentioned, these are boosted ETFs. And this is the core prospectus file to the SEC. I'm not going to bore you through all the technicals. And instead, what I've done is sift out a lot of the core insights and a lot of the core topics from this and built a PowerPoint from it. So hopefully it will be more streamlined and simple in terms of what's going on here. So as I mentioned, they're going to be doing boosted ETFs, boosted income ETFs that will have 150% leverage exposure to SPY, QQQ, and BTC. So, in the sense, you will get more leverage exposure, and for that, you're going to get a higher yield. And so they are promising a higher yield on all of these funds. It's going to be about 50% more yield across the board because of this synthetic leverage that they're going to bake in, okay? All right, so for QQQ, we have an opportunity now to deliver 19 to 23% in distributions or yield annually, okay, guys? So that's much stronger than the QQQI's 14%. So the benefit here for cash flow focused investors that are now comfortable with synthetic leverage, okay, synthetic option strategies, and those are complex, and there is high risk to that, to the downside and upside gains with that. But the target distribution for QQQI's boosted income is going to be 19 to 23%. These would, of course, come to you on a monthly basis. And of course, this is based on both a covered call income strategy and a synthetic leverage strategy where they're buying puts, they're buying calls, and they're able to synthetically create 50% more assets for you that then they can generate covered calls against. So it is high risk in this case. So you have to be comfortable with high risk. Not only are you betting on tech, not only are you betting on the bullishness of tech, but now you're adding in the element of synthetic leverage, which is confusing to some, adds complexity, adds higher management expenses and more complex management, and certainly is a higher risk to the downside and to the upside, and gains to the upside. All right, so of course with the NEO strategies, you're going to see tax advantages. They're probably going to return to the majority of distributions as return of capital, which will reduce your cost basis over time, and you don't have to pay tax up front with distributions. And then also they have a 1256 benefit for some optimizations outside of the return of capital distribution. All right. So another key benefit as it relates to NEOS is they're a proven team, and so they're adaptable. They know how to manage risk, and they've proven that with SPY-I, with QQQI, with BTC-I, and a lot of their other positions. They've proven to kind of be market leaders at this point in the covered call space, and a lot of their assets, a lot of their funds have been doing really well. So for QQQ's boosted strategy, of course, you're going to be investing in QQQ, so top 100 companies that are tech focused, 45 trillion in market cap with combined assets under NASDAQ 100. So you're buying the best and brightest tech companies in the world with some of the largest market caps. All right, guys, so for this fund, the uniqueness of this fund is now we have 150% exposure to QQQ. So there's two layers to this strategy, right? Layer one, they're going to hold underlying assets of QQQs, up to 100% of the assets under management, and then they're going to expand that with a layer two and utilize a synthetic exposure option strategy where they buy both a call against the QQQs and a put against the QQQ to effectively create 50% exposure, incremental exposure to the underlying assets, and then they will write additional call options, covered call options or synthetic call options against that 50% exposure, increasing our income potential, right? And so this is great in upward markets, right? Where if the market is bullish, you're going to get 150% gains on that, but also works to the downside. Any percentage move, 1.5% would be the negative loss, right? So it's a risky bet. If you are bullish on QQQ and you want the additional income and you're okay with their management style and want to take the risk, this synthetic exposure is a benefit to you. Or if you're risk adverse and are more conservative, you can focus on SPYI, QQQI, and some of their tried and true covered call strategies. Just simulating it a bit more, right? So if the market were to rise 10%, the fund's exposure is 15%. So they'd see a 15% gain. If the market were to decline by 10%, and then this fund's exposure would decline by 15%, right? So that extra 50% exposure, right, is going to positively impact you during bullish times and negatively impact during negative times, right? All right, so these risks, as I mentioned, right? So there will be return limitations, right? Of course, it's a covered call strategy. So while you are getting the amplified leverage, it's still, you're going to get the income, and the trade-off is your upside is still capped by way of the covered calls. As I mentioned, this is a multi-layer option strategy. So there is a lot of complexity to this, and the fund will lack historical performance. So we want to monitor them as they come out. And, is the distribution going to be sustainable, right? There's going to be a lot of volatility. Sometimes that's a good thing for covered calls. Sometimes that's a bad thing if we have notional exposure, right? So is that market stress going to, degrade the distribution potential of that 18 and 19 or 20% gold distribution? So if you want 19 to 20% in distributions, if you understand leverage and synthetic options, and you have an appropriate allocation to this strategy, I wouldn't, of course, it's not financial advice, but by no way I would allocate the majority of my assets to something like this. It would be much more of a, test and learn and see how it goes approach with something like this. And I know there's others from other funds outside of NEOS that are doing boosted or leveraged covered calls. So we're going to look at some of those in the future. But guys, what do you think about this? Is this something that you would invest in? Are you being cautious with this? You cannot yet invest in it. It is not yet public, but you have your eyes on this. Let me know in the comments below, guys, and all the best and cheers.